All right, morning everybody. This is Sam, and I'll start this morning presentation today. I'll start with a very brief overview of what's happening about the interest rate hike, and then my friend Dehong, he will guide you through the REITs the REITs sector outlook. So to start with, we would like to reiterate that we still expect that interest rate increase will only happen in September and December. Uh, Most likely by September. The beginning of the tightening cycle has historically coincided with the strengthening of the economy, which is a good thing because usually the monetary policy starts to tighten when the economy is doing well, turns which I will show you that turns out to be a positive thing. We would like to reiterate another thing that volatility may pick up as the timing of the Fed's initial rate increase approaches. So by the time like August September, the volatility, the VIX, which measures the volatility, might increase. We also recommend to maintain a diversified asset allocation to buffer individual asset class swings. To be very exact, the last monetary tightening happened around 10 months ago. Uh, If you look into the chart on the right-hand side, you would see that during the period between 2001 to 2004 was time when the interest rates were around 1%, and those were the days when this was the lowest they could go. And after 2004, they start to increase in monetary tightening, what we expect to happen in 2015 again. Between 2009 to 2015, interest rates were almost zero, as you can see on the chart. And so what we expect is that something similar to what happened in 2004. Before I share some trivia, here are the two sectors that we are quite bullish and heavily weighing on, consumer discretionary and the industrial sector in US. And we remain positive and overweight on the US market overall. Okay, some trivia on some comparison between 2004, when the first interest rate hike happened, I mean 10 years ago, and compared to 2015. Uh, both had seen the recession earlier, like in 2001 and 2008, and so they adopted the loose monetary policy. The only difference is that the economic growth in 2015 so far hasn't been I mean, great. It is quite uneven, and the headline, not the core, but the headline inflation still remains subdued. In terms of labor market, the unemployment rate prior to 2004 and just now remains almost the same at 5.5%. Participation rate is quite similar as well. The monthly job growth over the 12 months is better today compared to back then in 2004. Core inflation, like I said, headline inflation remains subdued, with core inflation, excluding food and energy, remains what it was back then in 2004. Other stuff such as retail sales growth lower in 2015 compared to 2004, but auto sales higher and then industrial production slightly better. Uh, capacity utilization also around 78%, which tells that the situation around 2004 and 2015 were quite similar. And well, historically, I mean, the history suggests that the equities usually underperform immediately after the rate hike, after the liftoff, and then they recover quickly and subsequently outperform. And if you look into 2004, when the first is start to increase the interest rate, uh, the market dipped for a while, but you would notice that between 2004 to the crash in 2007 to 2008, market rallied. So this is what we expect to happen, especially if the economy, the U.S. economy and the global economy continues to do well and improves, will help the equity market to really um, for next few years again. Uh, few more stuff. Last time we were saying that there might be only one um, interest rate hike of 25 basis point. Well, by now, the median of the projection implies that the Fed might increase it twice, so 25 basis point each. Might do it in September and December, but uh, we believe that it might happen between September and March, so they might miss one in one of the meetings. Um, and the median projection is mentioned by the F through the FOMC meeting is that they have revised down that by the end of 2016, the interest rate might be the median will be around 1.63%, and by the end of 2017, might be 2.88%. Uh, that's all from me. I'll pass it on to my colleague who will talk about the REIT sector.
Hi guys, De Hong here. So next up, we're going to talk about REITs. Just a brief update on the REIT sector, because picking up from where Sam left off, there were there were a lot of expectations about a rate hike this year, and from last month, late late in the month, late May, we saw that the REIT index actually suffered a correction because likely triggered by the fact that there was a surge and a spike in the Singapore 10-year government bond yields. So last week, Business Times actually ran this article. They were showing the inverse relationship of the 10-year government bond yields versus the REIT index. And if you look at this chart, it shows that each time the bond yields go up, the REIT index suffers a correction. And the primary reason for this is because REITs intuitively they're treated like a quasi bond or like a quasi yield instrument. So bonds, when if you buy a bond, when yields go up, your your bond prices tend to suffer a correction. So where do we go from here, right? Singapore 10-year bond yields last 2 weeks we saw a spike. Where do we go from here? So we see that because of the way the MAS conducts its macroeconomic policies, in that we tend to we control they control the currency and leave the interest rates more open to external forces. So if you look at our 10-year bond yields versus the US Treasury 10-year yields, right, you actually see a very close correlation there. So the table that you saw in the Business Times article last week, you saw this table, is actually over here in this small little portion here at the start of 2015, where we are seeing a surge in this bond yields. So what investors should also pay attention to is to take a step back, look at the zoomed out picture, and if you take a more zoomed out picture of where yields are going, if we take a view for the past 10 years, we will see that yields are actually on this downtrend. And coincidentally, we saw that US 10-year bond yields last week, they actually hit a high of about 2.4 to 2.5, right exactly where this downtrend line is, and they bounce back downwards. Now it's about 2.2 plus. So on a 10-year basis, we see that the yields are still on a downtrend, yet to have broken up above the downtrend line. And if you take a look at an even more zoomed out picture, right? You take a look at since 1980s, where we had this start of the secular bond rally, right? Back from in the 1980s, where yields used to be above 10%, we had a major bond rally. Yields started to come down. For the past 30 years, we have had yields coming down from over 10% to right now where we are, less than 3%. You see that the 30-year chart actually offers an even more compelling picture in that the bond rally doesn't seem to be over yet. It will someday, but right now the downtrend line seems to be still supporting pretty nicely there. So we've talked about long-term use, and right now we take a look at how the REIT index actually behaves versus the 3-month swap offer rate. We are using the swap offer rate because we feel like this is the most direct impact to REITs, because a lot of REITs, their debt are actually, the interest rates are actually pegged to the 3-month SOR. So when SOR goes up, traditionally you will have REITs having higher financing costs because their debt is pegged to the SOR. So we saw that from what Sam said earlier on, back in 2004 where there was a rate liftoff, SOR was going up tremendously up until 2007, but yet we see that the REIT index follows the same trajectory in that even though interest rates were going up, the REIT index follows suit. So even though you say that, traditionally people say that, oh, interest rates are going up, REITs are going to do badly, financing costs are going to go up. But in that period of time, we actually saw REITs move up in tandem with interest rates. So then came the GFC until 2009. Following that, we saw a sustained period of low interest rates, and that helped REITs as well because of low financing costs, right? So then now you may ask, okay, so what is the conclusion, right? So am I trying to say high interest rates is going to be good for REITs and low interest rates is good for REITs as well? So we are not having any clear conclusion, right? So my point is that if you look at it from a pure like single dimensional perspective, in that, or you treat REITs as bond as yield instruments, and that when interest rates go up, then REITs are going to underperform. I think that is too single dimensional, too narrow a perspective. A lot of times it really depends on the growth of the REIT, because even though REITs, a lot of people buy REITs for their yield, the difference between the REIT and the yield is that if you buy a bond for $100, you get a coupon of $5. The coupon stays the same every year, but for REITs, there is actually this growth element to it. Like for example, if you look at Fraser Centrepoint Trust, right, from the time they IPO'd until today, every single year they've managed to grow their DPU, even throughout the 2 years of the financial crisis. So that is the difference between the REIT and bonds. So my point is that to look at it from a single perspective, in that when interest rates go up, then REITs will underperform, is too narrow a perspective. A lot of times you have to consider where the general economy is, whether there is growth in the economy, whether the REIT is able to get positive rental reversions. So these factors are as important, if not more important, than just considering where interest rates are going to go. And okay, next we have FOMC and Janet Yellen, right? In June, they had this news conference on the FOMC for that month. So Lindsay mentioned about IMF and OECD advising the Fed to only raise interest rates in 2016 and not do it earlier, so as to not derail the recovery of the economy. So when Janet Yellen last week was asked about whether Fed should listen to IMF's call to wait until 2016 to raise rates, this is what she had to say. She said, the importance of the timing of a first decision to raise rates is something that should not be overblown, whether it is September, December, or March. So what matters more is the entire path of rates. And for that, Janet Yellen has actually assured that the entire rate hike process is going to be gradual and is going to be catered to prevailing economic conditions. Because we can be sure that, after 5-6 years of hard work, keeping interest rates low, trying to kickstart the economy, you can be sure that the last thing they would want to do now is to raise interest rates too fast and derail the recovery of the whole economy and undo all the good work they've done, right? So I think right now we're in this situation where, you know, we don't know whether the growth in US is sustainable, it's gonna be sustainable. And rates are only going to go up if they see signs of it being sustainable. And if it's not, then they will not raise rates so fast. So this kind of conditions versus like you see that in other countries, a lot of other countries, they're actually still adopting very loose monetary policies. You see EU having QE, you see China lowering interest rates. These two regions are right behind US in terms of GDP. And you have like India lowering interest rates, Australia as well. So you really see that a lot of other parts of the world, they are still keeping their poli- policies relatively loose, which are accommodative for growth. And if you're still not convinced about all this, like what Sam mentioned, historically, even after rates go up, equities, even though they will suffer a knee-jerk reaction at the start when rates go up, but over the long run, they tend to outperform. So I should have added a chart over here to the purple line because this is the REIT index, right? So this REIT index actually shows a very strong correlation to the STI index. And next, for a lot of our valuations the models that we use to value the REITs, we actually have this input, which is the risk-free rate that we need to use. So in a nutshell, risk-free rate, a proxy to that, we use the Singapore government securities, the 10-year bond yield. So when risk-free rates are low, they actually, when risk-free rates are low and they are increasing, they actually tend to reduce the attractiveness of the equities asset class. Because let's say if you have risk-free rate at 1% and your stocks are yielding 5%, so you have a spread of 4% in exchange for the risk that you take on for investing in equities versus if you invest in a risk-free bond. So that 4% premium is probably enough for you in exchange for the risk that you're going to take. But if your risk-free rate is going to go up, and let's say it goes up to 3%, your stocks are still yielding 5%, your spread becomes only 2%. So 2% may not be able to compensate you for the risk that investors are willing to take. So if the risk-free rate goes up and the spread becomes insufficient, then stock prices may correct downwards so that their yield is improved. So for us, in a lot of our valuation, we have factored in a 3.1% risk-free rate. And that compared to where the Singapore 10-year bond yields are right now is about 2.5, 2.6. So you can see that a lot of our target prices, they have already more or less factored in the rise in the rate hikes. Because if you look at the 10-year bond yield rates over the past 10 years, right? The last time we ever hit 3.1% was during the GFC. And after that, there was not a single point in time where we actually hit 3.1. So using 3.1 actually decreases the valuation price. And you can say that our valuation models have already more or less factored in an impending rate hike. So one more point about S-REITs now is that you look at the four geographical regions that we are trying to compare. We compare S-REITs with US REITs, they're the largest REIT market in the world. We compare S-REITs with Japan REITs, they're the largest REIT market in Asia. And we compare S-REITs to Hong Kong REITs. And if you look at the number in the box, these numbers are actually the spread of what the REITs are yielding versus the risk-free rate in that particular country. And if you look at the spread for S-REITs versus the peers, right, we still offer value versus the US REITs and the J-REITs. As for the Hong Kong REITs, their spread is currently higher than us, but I think the difference between Singapore REITs and Hong Kong REITs is that for Singapore REITs, we actually offer more diversification in terms of geographical regions and the kind of properties. For instance, in Hong Kong, most of the REITs are actually primarily focused on they're either office properties or they're retail malls or hotels, and the geographical regions they operate in are mostly Hong Kong or China. So if you were to go to Hong Kong and buy a REIT, your exposure, your the kind of diversification they offer is pretty limited. If you were to talk about the same kind of geographical region and the same kind of assets, what we have in S-REITs are Mapletree Greater China Commercial Trust, which has a retail mall in Hong Kong, office buildings in Beijing and Shanghai, and we have CapitaLand Retail China Trust. That one is having retail malls in China, primarily Beijing, right? So these two are the most comparable REITs to what most REITs in Hong Kong has to offer. And if you look at those two REITs on the STI and on the SGX, the two REITs that I just mentioned, they are both trading at about 6.5% now versus our risk-free rate of 2.5. So those two offer a spread of about 4% as well, which is pretty similar to what Hong Kong REITs are offering. So my point is that, as REITs, we still offer value over J REITs and US REITs. And at the same time, we also offer more diversification and across more geographical regions as well. You can be exposed to healthcare in Indonesia. You can be an part owner of a golf course in Japan. You can be exposed to healthcare in India as well. I think the most interesting REIT in Hong Kong should be Link REIT. The the kind of assets they own can even be like fresh markets or even 大排档s, the food stalls that you have in Hong Kong. That should be the most interesting REIT I've seen. But other than that, it's pretty much single dimensional, just office buildings, hotels, retail, Hong Kong and China. So to top it off, we give a summary and a conclusion of the 6 REITs that Richard and I have on offer. We have Croatia's Retail Trust because of pro-growth Abenomics and growth in Japanese consumer confidence and spending power. Soybuild REIT because of decentralization of commercial activities to suburban business parks. CapitaLand Retail China Trust because of the increasing spending power of Chinese consumers. First REIT because of their ramping up of hospital networks at the most opportune time. Cash Logistics because of their portfolio of quality warehouses. And lastly, Fraser Centrepoint because of their portfolio of resilient heartland malls. So the week ahead, we have a bit of good news, a bit of bad news. Good news is that the entire Greek drama is going to come to an end soon. We have an emergency EU summit that is called and it's going to be held today. And if that fails, we have one last chance that is the EU Leaders Summit in Brussels. That's going to happen on Thursday and Friday. That could be the last chance of any sign of a Greek deal before the end of the month where Greece is due to pay the debt due to the IMF. So do look out for these two meetings this week. Okay, with that, I've come to an end, and feel free to ask if you have any questions. Hi, there is a question on Croatia's, whether it's still a good time to buy Croatia's. Now, our house still has a buy call on Croatia's with a target price of 108, and we're still bullish on Croatia's because most of their assets are actually having long lock-in periods, and you look at the occupancy tables for a lot of their properties, they're actually very close to 100% as well. And this year we expect rental reversions to be driven by uh, reversions at Malaj Shobu, one of the malls which they just late last year had a round of rental reversions because the previous round of rental agreements in that mall were actually set in 2008. So there was a time where rental rates were still very depressed. So the rental reversions late last year should give it a good boost in the rental rates that the mall is achieving. So that one and another acquisition late last year, once more, these two should be driving the DPU this year. And then we are also bullish in that you look at Japan right now, you look at the kind of policies Abenomics, the PM and Abenomics is having. They're trying to kickstart the economy, right? They're trying to pull the country out of decades of inflation. So the PM is trying to actually start from boosting wages of the Japanese. He's gone around speaking to corporate leaders, asking them to you know boost their wages, and then we think that this kind of policies in the long run, they're gonna have they're gonna have a support and a boost to the retail spending sector in Japan. And I think there was a comment earlier on about why are we recommending this, but the price is not moving, is correcting downwards, right? But if you look at Croatia's right now, I think it is still pretty near where the top in the last 2 months. I mean, if you look at the chart, it's been on a nice uptrend. The highest it achieved in the last few months was 96 cents. Now it's about 93 cents. Slight correction in tandem with the REIT index in the last 2 weeks, but I wouldn't see this as very much of an issue, as in like I think the uptrend is still pretty strong. Hi, there, there is another question on whether there's an ETF to invest in Singapore REITs rather than invest in individual REITs. Unfortunately, there's no such ETF at the moment. Hi, there's a question on which sectors of REITs offer better return at this current moment. Okay, we had this REIT sector report about 2 or 3 weeks back, and in that report we actually did a review on the different sectors. But right now we actually, because things are getting pretty volatile now, we wouldn't advocate looking at it from like as a one-dimensional, just saying that this entire sector is more defensive, so it's better. Because if you think about it, traditionally people will think healthcare is like a traditionally a safe haven, the more defensive of all sectors. But if I were to look at it within healthcare, if you look at let's say like stocks have like let's say um let's say Religare, right? Their model is actually based on percentage of revenue of the hospitals in India. It's not entirely that case, but given that is as a percentage of revenue, there's some volatility expected down there. And if you talk about that sector as a whole, I mean I look at retail sector, and if you say retail is supposedly one of the more responsive sectors, but within the retail sector, we still find that there are good defensive plays within retail sectors such as Fraser Centrepoint. So in current times, we would advocate looking more at the strong individual REITs, adopting a more bottoms up approach at this current moment, because admittedly, when you look at the chart I showed you earlier on, you look at this chart, right? Okay, this growth period from 2002 onwards. 2002, when we had the first REIT listing in Singapore, CMT, right? There was strong growth all the way until 2007. But that period of time, we're actually seeing REITs being relatively new, so balance sheet not too heavy yet, gearing still at lower levels. So that period of time, they were able to grow faster. So right now, gearing is slightly higher, but after the GFC, most REITs still adopt a very prudent balance sheet. So it really, I think at this point we should be looking at bottoms up approach, and not to consider sectors as a whole. But if you talk about sectors as a whole, I think generally we are pretty wary of the office sector at the moment, as we have already covered from our first one of our first REIT initiations in February. In that, it's gonna be pretty not so easy for the office sector because of the huge supply coming up. Even though it's not even though it's not yet here, it's only coming in 2016. But as landlords get more nervous to start to get tenants in, I think they will start to throw in more discounts, or they will try to throw in more carrots to lure in tenants. And tenants, knowing that the huge supply is coming up, I think the ball is gradually shifting in their favor as well, and they have got more and more bargaining power. Hi, there's a question on Magic Maple Tree Greater China Commercial Trust and what we think of it. So, Magic, we do not have an official house view on it. We have not done in-depth valuations on it. So, but offhand, what I feel after attending their results briefing in the previous quarter is that I feel like this set of management, they are actually okay. So first off, they own one retail mall in Hong Kong, one office building in Beijing, and one in Shanghai. So the feel I got after attending the briefing was that this set of management is a very proactive set of management in that they are able to actively readjust the tenants for their shopping mall in Hong Kong, and because of that, they are able to get very healthy rental reversions for the shopping mall in Hong Kong. So currently trading at about 6.5%. We do not have an official in-depth view or carried out any in-depth valuations on it yet, but I do agree that this stock is worth looking into.
Okay, there's a question on how will the Greece issue affected the whole equities market? Seems like it is running out of time and Greece may default soon. So just like just like my colleague Dehang just mentioned that today they have summoned an emergency meeting and they might be discussing about the negotiations that they have been doing for so long. And our house stance is that there's a 50-50 chance that they might come up with a negotiated terms or they might not. If they do come up with a negotiated terms, then probably the market will rally, and this entire Greece havoc or whatever you want to call it will be. I wouldn't say it will be kind of like postponed only. It won't be uh, done with. So if but in the case if it does not, then you will see the European market is and most likely the rest of the markets as well to 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 go down, and the timeline for that is 30th of June because they need to pay off the IMF loan by 30th of June, which is around $1.6 billion. They don't have money right now, so they can't pay it. So they need to negotiate, and then the IMF and the Troika, the so-called Troika, the ECB, EU, and the IMF will have to release funds so that they can pay back to the IMF. But that depends how the negotiation goes. If nothing goes on, they don't pay them the money, most likely Greece will default. Now, default does not mean that they are kicked out of the eurozone. There's no such thing that if a country goes to default, they will be kicked out because it's not there. So the Greece exiting the eurozone might still take few, I don't know how many months before that thing is settled down. But for now, those clients who want to like take short-term profit, short-term profit. Yeah, on both sides might look into this situation very carefully, and as soon as anything comes out, will drive the market. And for us, it's a 50-50 thing, so we can't call whether they will or they won't.
Hi, there's another question on what about Australian REITs? Because if we say Australia is going through another rate cut, versus US, they're going through a rate hike. So what about Australian REITs, right? Is that going to be good for Australian REITs? No, we don't have any recommendation or any call on Australian stocks. But the thing to bear in mind is that a lot of other factors, not just interest rates, actually should come in. There are a lot of factors like if you are an Australian REIT, is the office sector there doing well? Is the retail sector there doing well? How is the general macroeconomic environment like? A lot of these other factors play in as well, and it's not just simply looking at rate cuts and rate hikes like what we mentioned. And then also another thing is if you were to buy a REITs, right? If you say rate cuts, there could be a chance of capital outflows as well, and you are exposed to currency exchange risks as well if you buy a REITs, because as it is from the start of this year until now, we have already seen a 4% depreciation of Aussie dollar versus Sing dollar. So that is what I have to say. It's not just simplistically looking at rate hikes and rate cuts, as we mentioned. Hi, there's a question on First Street whether we think it's still worthwhile buying at present market price. So we offered an initiation on First REIT, I think 1 or 2 months ago. At that time, the price at initiation was about 144, and we still have a target price of 155, so we are still bullish on it. We have an accumulate call on it. We still think it's worth buying because of the ramping up of its hospital networks in Indonesia at a time where demand is expected to surge because of the increased insurance coverage for Indonesia. So you guys can refer to our initiation report on First Read for that.
Hi, there's a question on ARA asset management, REITs that are linked to ARA management, and what's the view on such REITs that are linked to them? I think that it is not possible to give a sweeping statement based on just um, the what on REITs that are linked to asset management, and to our advice is to look at the REITs individually on a case by case basis.
Right, there's a last question on what's the connection between 10-year bond yields and property stocks. So I think it's if you look at property stocks, there are a lot of factors to consider. It cannot be just one dimensional looking at interest rates. So 10-year bond yields may go up when interest rates are going up. But you see the period of time from where Sam was talking about just now, after 2004 when there was a rate boost off, right? That period of time, 04 to 07, it was a period of very strong growth for equities, for economies and equities around the world. We we grew very strongly. We topped at 2007 before we crashed off after the GFC, right? So that period of time, interest rates were going up, but property stocks were doing well as well. Property prices were going through the roof as well. So if you think about it, like intuitively, you think about interest rates going up. It shouldn't be good for properties because people have to pay more on their mortgages. Affordability gets lesser. Right? At the same time, you got to look at a lot of other factors as well. Supply of houses, demand for houses, government policies as well, which is a very important factor. So right now, our government is tightening, and there's a lot of debate about when they're gonna release all these tightening measures. So it is it wouldn't be there wouldn't be a straightforward link to say what is direct link between 10-year bond yield and property stocks. Okay, with that, I think we have come to the end of our webinar for today. Thank you for tuning in, and do tune in again next week. Thank you.